Okay, I'm going to walk through the test one problem review section so that you can have some explanation behind the solutions. So here's our first problem. So Oakland Company has this balance sheet and they are acquired by Soccer. So this is the only one that we're doing that acquisition, that asset acquisition entry. So that's A. So prepare the journal entry if they acquire their individual assets and liabilities. So that means they're not acquiring the stock. B, they're acquiring the stock. So then A, we take all of their assets and we record them. So we take their current assets, their property, plant, and equipment. Now over here, I'm showing you how to calculate the goodwill. So we paid $30,000 for their for this purchase, their net assets. Their net book value is $26,000, so we paid an additional $4,000. So that is where the goodwill comes in, and then we record or we assume their current liabilities at $60,000. We assume their long-term liabilities at $48,000, and then we gave up $30,000 in cash. So again, this one is a fairly short one. They could have a lot more assets, or they could list out those current assets. But basically, those are the steps. We record all of their current assets on their books. We assume all of the assets, whether they're current or long-term. We record all of their assets on our books. We record all their liabilities on our books. We credit what we paid. Now, again, we could give up cash, which means we would credit common stock at the par value and then the paid in capital for the difference. This one's a little easier, just crediting cash. But then the difference, what we need to make this entry balance, is going to go to goodwill. Now the second entry, if we just buy the stock, we're going to set up the investment in the subsidiary or the equity investment, and we're going to debit that for $30,000 and we're going to credit cash. So the investment in sub is the same as the equity investment. Okay, then what if, as we move into the next chapter, it'll be equity investment. Chapter one, we're still not, we're just doing the basics. So that's why it's the investment. Okay, then the next problem, we have a parent and a sub that are selling product back and forth to each other. And we need to prepare the equity method entries to deal with their net income, their dividends, but also this gross profit on the inventory sale. So we're just focused on 2012. I think I do give you 2013, but it's really just asking for 2012. So 2012, we purchased the small company for $350,000. So that would be our price. We paid cash. Then during 2012, the small company, the subsidiary, sent to the parent merchandise that cost them $40,000, but it had a selling price of $65,000. So they marked it up. So they marked it up $25,000, and that's fine that they do that because that's what they do. The big is a customer to small, so they can mark it up. What we're not fine with is this next sentence. 25% of that merchandise remained in Big's ending inventory, and it was not sold until the next year. So then we have a $25,000 profit. That 25% of that, which would be $6,250, is still in our ending inventory, and it's overstated by that profit because again, we own them 100%. We need to back that profit out unless it is sold to an outside party. So remember that $6,250 is 25% of the gross profit because that's what's left. Okay, then small reported net income of $40,000 in 2012, and then they paid dividends of $5,000 each year. So the equity investment is, we debit the equity investment for the price that we paid, $350,000, and we credit cash. Then here, we're going to record the equity income. Now notice though, I'm going to adjust it. Now you could do this in two separate entries if the problem is asking you to. So the net income of $40,000 is going to be reduced by that 25% of the gross profit that's still hung up in our ending inventory. So we have to reduce the net income. So then our adjusted balance is going to be $33,750. Oh, I'm sorry, I missed that we only were at 50%. Let me go back. Yeah, so I'm sorry, I said 100% when I talked about it. We're only 50%, we only own 50% of that. So then we get to their adjusted gross income, and then we need to multiply that by the 50%. If we owned them 100%, that would be what we would do our entry for, but we do not. So we multiply that by our 50%. We're going to debit the equity investment for $16,875 and record, again, our 50% of the equity income, $16,875. Then when the cash comes in, we receive the cash, and then we reduce the equity investment. Now then I show you the second year, which is good to see it. Now in the 2013, we have net income of $42,000. We have gross profit that we deferred in 2012, that $6,250 tells us it was sold out, so we can now record it. Then our 2013, we had $22,000 of gross profit. 30% is left in our ending inventory, so $6,600 needs to be deferred. So then that gives us our adjusted net income, and then again it's at 50%. So that's what we would debit to our equity investment and credit our equity income, and again the dividends would be the same way. So just remember that we don't defer, or we don't reduce it by all of the inventory, only the stuff that's left in our ending inventory and only the gross profit piece. The inventory still exists, we just want it back down to cost. So that's why we make these adjustments. Okay, then we get into chapter 2 where we are consolidating at the date of acquisition. So here are the two companies, the parent and the sub, and their balance sheet right before the acquisition. They tell us the Illinois company issued 220,000 shares of $5 par value common stock valued at $19 a share. So again, if we take the 220,000 times the $19 a share, that's $4,180,000 that they paid to acquire North Dakota, all of their outstanding stock. Then we say, okay, well, what did they get in that? So they also have a patent that's worth $100,000 that is not on North Dakota's books right now, and their property, plant, and equipment was undervalued by $50,000, and then the remainder is going to go to goodwill. So as we look over here to the left, I've kind of mapped that out. So the 220,000 shares at the $19 a share gives us that purchase price of $4,180,000. Then if I go back real quick, the common stock of North Dakota is $1 million, the paid-in capital is $200,000, and then the retained earning is $2,420,000. So then those are the values that I'm subtracting here. Those equal the book value. So that leaves an acquisition accounting premium of the difference, $560,000. And then we go back to the problem to say, well, what does that relate to? It told us a patent of $100,000, property, plant, and equipment was undervalued by $50,000, and then the remainder goes to goodwill. So again, remember that goodwill is the difference, or the plug, to get my acquisition accounting premium assets up to the $560 extra $1,000 that we paid. And then, like I said, in the chapter, in the problems we worked out, these build, the book value builds our E-entries, and the acquisition accounting premium mapped out builds our A's. So then we're going to debit common stock for $1 million, debit paid-in capital $2 million, debit retained earnings $2,420,000, credit the equity investment, debit our patent for $100,000, debit property, plant, and equipment for $50,000, debit goodwill for $410,000. So these are putting these assets on the books, crediting the equity investment. And then you can just double check it. $3,620,000 plus $560,000 gives us our $4,180,000. So then we know we're good. Then here is the consolidated spreadsheet. Again, nicely color coded. Journal entries go in. we can see that we're increasing the value of our property, plant, and equipment. Our E and our A entry eliminate the equity investment. We're adding the patent and the goodwill to our consolidated balance sheet. We are eliminating the subs, common stock, paid in capital, and retained earnings. So all that is left is our parents' equity accounts, and then our balance sheet actually balances. We always have to double check that. Okay, then chapter 3, the summarized problem just asks for specific things. So the key to these specific things, a lot of them go back to the rules. So like I have those in each week's materials folder or week's lessons folder that shows you what are the rules, what do you want to remember. You know, that our retained earnings should always end up equaling our parents. Our net income should equal our parents. Our equity investment is zeroed out. Our equity income is zeroed out. Those rules. Because again, you don't even have to do the work of some of those to just get them. So then as we go through it though, this is the stuff that it asks for. So A is, darn it, I don't have the, do I have it on there? No. Okay, so A is going to be our cost of goods sold, I believe, added together. So that's the parents' cost of goods sold plus the subsidiaries' cost of goods sold. So those we add, there's no eliminations. Then B is saying what is our equity income. So we know it's eliminated in consolidation, so it's 0. Then C says what is our operating expenses. So our operating expenses are $496,125 for the parent, plus $797,550 for the sub. But then we want to remember in consolidation, we're going to amortize this patent. So the patent has a $200,000 value and a 10-year life. So then that's $20,000 a year, so we have to add all 3 of those together. Then D is our cash and our accounts receivable. So again, no adjustments to those, so we just add those 2 together. Then E is our equity investment. So again, remember the rule, we're going to eliminate that completely in consolidation, so that's going to be 0. Then F is our patent. So again, the patent, if we look back here, there is no patent on the books anywhere, but we know we're going to add it in consolidation, and we are now 5 years out. So then we want to take the patent's value at the date of the acquisition, subtract out 5 years of amortization, so our ending balance of that patent is going to be $100,000. So again, look at the dates, make sure you amortize it out for the right amount of years. Then our goodwill is we paid $450,000 excess dollars, so here it tells us that. And of that, $200,000 went to the patent, and then the rest went to goodwill. So then that would be $250,000 in goodwill. And then H is our common stock, our common stock. So remember, our common stock, our paid-in capital, and our retained earnings, all of those are going to equal the parents. So again, we don't have to do any math to it. We just know it equals the parents. And then that's the same. And then I is the retained earnings. And again, that's going to equal the parents. So there's only a handful of these that we actually have to do math, as long as you know your rules. So print those rules out so that you know them. So again, you can kind of easily answer some of those questions without having to kind of spin your wheels and do a lot of the math work. Okay, then our chapter 3 consolidation problem, which is going to be the biggest one. It is going to be, again, chapter 3, we're after the acquisition. So this acquisition happened on January 1st of 2013. We are now at the end. We're at December 31st of 2013, and we have our parents and our subs financial statements at the end of that year, and they tell us that we had property, plant, and equipment that was undervalued by $125,000 with a 10-year service life. Also a patent at $100,000 with a 10-year service life. So those will just divide by our 10 years to get to our depreciation. The first thing I always do though is kind of map it out. So our purchase price, whoops, let me go back. The purchase price was 35,000 shares at $14 a share. So that's what we see here. That gives us a $490,000 purchase price. Then we're going to subtract our common stock, our paid-in capital, and our beginning of the year retained earnings. So those are provided right on their balance sheet. So common stock of the sub, paid-in capital of the sub, beginning of the year retained earnings of the sub. So we subtract those out. Those total $140,000. That leaves a $350,000 acquisition accounting premium that relates to our property, plant, and equipment for $125,000, our patent for $100,000, and then our goodwill again is a plug to get those acquisition accounting premium assets up to the $350,000. And then again, just thinking about it, these represent our E entry, these represent our A entry. But then now we want to reconcile out our equity income. So again, flip back over here. The sub's net income is $29,400. The equity income on the parent's books is $6,900. So we want to account for the difference. So we start with the sub's net income, $29,400. We subtract the depreciation on the property, plant, and equipment, and we subtract the amortization on the patent, and then we see that we tie out to the equity income that the parent shows on their income statement. Then they ask us to tie out to our equity investment. So the equity investment is $492,100 on the parent's books. We know that we've got our book value of the sub, the common stock, paid-in capital, beginning of the year retained earnings totals $140,000. We've got our acquisition accounting premium assets that total $350,000, and then we're going to eliminate the equity income of $6,900, and then we're going to eliminate all of the dividends. So again, the dividends that the sub paid, not the parent, just the sub. So the $4,800, and then if we add those three together, we get to our $492,100. So then the only entry that is not mapped out completely, well, I guess it is up here, is that D entry. So we've got all of our entries mapped out. Now we just have to put them into our consolidated statements. And again, like I said, when you're preparing these on your own, make sure you are properly noting if they're an A entry, an E entry, a C entry, and then color code them. I don't think you have to do that part in the homework, but if you're preparing your own Excel, it's very nice to have them color coded. So again, we eliminate our equity of the subsidiary. So we debit common stock, debit paid-in capital, debit beginning of the year retained earnings. The credit goes to equity investment. We set up those new assets. So increase our property, plant, and equipment, new patent, new goodwill. That credit goes to the equity investment. We eliminate our equity income. We eliminate the sub's dividends. The net of that goes to the equity investment, and that zeroes our equity investment out. We record our depreciation and amortization expenses and reduce our property, plant, and equipment and our patent accordingly. Then we go through our double checks. So our equity income is zero. Our net income equals our parents. Our statement of retained earnings equal our parents' statement of retained earnings. Equity income is zero, equity investment is zero. Our common stock, paid-in capital, and retained earnings all equal the parents. So if you can just get those rules mapped out, write them on a note card, keep them handy, remember them, it's going to help you know that you're doing these statements correct. And that is it then for the problems on test 3. Again, the multiple choice, look at your review sheet.